Hey everyone, welcome to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. So glad you're joining us. We're going to take some of those really complex, head-scratching accounting standards and just break them down into super clear, actionable insights that you can actually use.
Now, let's kick things off with a pretty fundamental question. Why should you even care about Indian accounting standards? Well, look, if you're putting your hard-earned money into the shares of a listed company, you absolutely need to understand these rules. Why? Because they literally govern the financial reality of the companies you're investing in. It's kind of like trying to read a map without knowing what the symbols mean. If you don't know how that balance sheet is put together, you really can't assess the true risk or the actual value of your investment.
Just a quick heads up before we unravel today's puzzle. The views I'm sharing in this explainer are entirely the personal views of the author, and, they aren't legally binding on anyone watching. We definitely recommend that you go ahead and seek the help of an expert before taking any action or holding back from any action based on what we're chatting about today.
All right, just so we're all completely on the same page, let's lay down some quick ground rules. For the scenarios we're looking at, the functional and presentation currency is the Indian rupee, INR. Any other currency? That's foreign currency for us today. And our reporting period? It's the standard financial year, starting April 1st and wrapping up on March 31st.
Okay, here's our roadmap for today's explainer. We're looking at the NBFC collateral puzzle, the rules of offsetting, the final accounting verdict, and finally, we'll explore the gap ecosystem.
Let's dive right into Section 1, the NBFC collateral puzzle.
So let's look at a super practical scenario, something that non-banking financial companies, or NBFCs, face literally every single day. Picture this. An NBFC grants a loan to a customer. The principal amount is 500,000 INR, so 5 lakh rupees. They agree on an interest rate of 12%, and the tenure for this loan is exactly 2 years. Okay, so far so normal, right? Just a standard financial setup.
But here is where things get interesting. Let's look at the security deposit structure attached to this loan. As part of the deal, the NBFC actually holds on to the last 2 monthly installments to act as a security deposit. Obviously, this is kept just in case the customer defaults. But here's the kicker. The customer actually earns an 8% interest rate on that retained amount. And that 8%, it's paid out in cash straight to the customer.
Now, assuming our customer is fantastic and honors their obligations flawlessly right through the 2 years, we end up with 2 possible settlement scenarios. In Scenario 1, the NBFC just adjusts that retained deposit directly against those final 2 monthly installments. Nice and easy. But in Scenario 2, the customer pays the last installment, and then the NBFC hands that deposit back entirely in cash.
And that brings us to the big core issue, which was actually submitted to the Gap Advisors issue repository. Under these 2 very specific scenarios, how on earth should these security deposits be shown on the balance sheet? Plus, when you're calculating the effective interest rate, the EIR, to recognize interest income, do you need to factor in that 8% interest paid to the customer? It's a bit of a brain teaser.
Moving right along to Section 2, the rules of offsetting.
To solve this little puzzle, we've got to consult the rule book, specifically the massive hurdle found in paragraph 42 of IAS 32. This paragraph makes it crystal clear. You can only offset a financial asset and a financial liability and show them as a net amount when, and only when, you have a currently legally enforceable right to set off the amounts, and you actually intend to settle on a net basis, or simultaneously. It is a super strict 2-part test. You can't just mash them together because it looks cleaner.
And it goes even deeper. Paragraph AG 38B lays out exactly what a currently legally enforceable right really means. To pass the test, this right cannot be contingent on some future event. No what-ifs. It also has to hold up across the board, in the normal course of business, in a default situation, and even if someone goes bankrupt or insolvent. And that applies to all counterparties involved. Literally no loopholes allowed here.
Let's jump into Section 3, the final accounting verdict. So let's apply these super strict rules straight to our NBFC scenario. Here's the problem. The right to set off the deposit against the loan? That belongs exclusively to the NBFC. It's totally one-sided. Because of this, the borrower is stuck carrying all the liquidity risk. The borrower doesn't have the right to just say, hey, I'm going to pay the net amount of interest between what I owe you and what you owe me. They can't force a net payment. Because of that, the strict criteria in paragraph 42A is absolutely not met. And because it fails that strict test, here is the final verdict.
Under both Scenario 1 and Scenario 2, you have to present the loan separately as a financial asset and present the deposit completely separately as a financial liability. You cannot blend them together. And since they are separate elements, that effective interest rate, you've got to calculate it independently for the loan and independently for the deposit, period.
But hey, accounting is always full of nuances, right? There is one specific exception here. Let's say the borrower actually did have the option to pay a net amount of interest, and both the NBFC and the borrower fully intended to settle those net amounts at the exact same time. If that were the case, then, and only then, could you offset the loan and deposit, but only in Scenario 1. It still wouldn't work for Scenario 2 because, remember, in that scenario the deposit is just handed back in cash at the very end.
All right, on to our final part, Section 4. Explore the GAAP ecosystem.
Now that we've decoded the whole offsetting puzzle, let's talk about how you can keep mastering Indian accounting standards. The deep dive we just did is actually based on real-world queries. Today's explainer specifically features an issue taken right out of the 205th edition of the GAAP Advisors Task Weekly newsletter that's authored by CA Manish C. Iyer, Director of GAAP Advisors, and it's published over on LinkedIn. So if you're on LinkedIn, you should absolutely subscribe to this for free. They've published over 230 editions so far. And if you want to take your expertise even further, listen to this. This exact issue and the response are from the massive issue repository over at gapadvisors.com. They host more than 4,500 issues and responses on Indian accounting standards and Indian GAAP. Anyone can register for free and submit their own issues to get a detailed response delivered straight to their inbox. That is incredibly useful, especially for auditors who need solid documentation on how they tackled an Ind AS application. Also, you can even book a one-on-one consultation about your specific Ind AS or IFRS issues with the author on topmake.ai. Make sure you follow the GAAP Advisors Ind AS Clinic channel on WhatsApp so you never miss an update on explainers, newsletters, or new standards. And for a really deep audio dive into these topics, check out the GAAP Advisors Ind AS Clinic podcast on Spotify, Amazon, or YouTube. Thank you so much for hanging out and giving us your time today. Please make sure to drop a like, add your comments down below, and definitely subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. And please, go ahead and share this explainer with your contacts, your colleagues, audit and finance teams, and especially students pursuing their CA course. It really helps spread this crucial knowledge of Indian accounting standards.
Finally, I'm going to leave you with a thought to chew on next time you're reviewing investments or doing an audit. Now that you understand the incredibly strict rules of IAS 32, how confident are you that your company's balance sheet isn't hiding some unoffset liquidity risks just lurking under a gross presentation? Think about that for a second. Take care, and I will see you in the next explainer.